Let's quickly talk about transitioning from partnership to S corporation. And I want to focus on the tax implications of such a transition. So here's the approach I want you to pay attention to. I want to first define for you the different legal structures that we're talking about here. So I want to start with S corporation. So an S corporation, also known as subchapter S, refers to a type of legal business entity. So the requirements give a corporation with 100 shareholders or less the benefit of an incorporation while being taxed as a partnership. And corporate taxes filed under subchapter S may pass business income, losses, deductions, and credit to shareholders. In other words, the company itself is not paying taxes. The individual shareholders or members are actually paying it. And shareholders report income and losses on individual tax returns and pay taxes at ordinary tax rates. So that's what we call about Schedule C sort of tax filing. And so S corporation shareholders must be individuals, specific trust and estates, and also members of certain tax exempt organizations. Okay, they got to be residents though. So an S corporation is pretty restrictive in terms of the membership here. Okay, so but if you qualify for S corporation, you're able to avoid double taxation. You're able to actually you're able to actually minimize your self-employment tax. You have an independent life in terms of how you manage your business. You have protective shield. You have transfer of ownership. This is kind of cool. Now, of course, when we talk about S corporations, there are some disadvantages, like lots of protocols. You have compensation requirements. You have extra work and cost. That's for sure. You have added restrictions. You have tax changes. So you have a constellation of things you have to take care of. But overall, by and large, the advantages of an S corporation outweigh the disadvantages. Okay, so basically, the thing is that if you qualify to actually own an S corporation, all you have to do is you have to elect S corporation for tax purposes, because there is no such a thing as S corporation legally. So at the state level, you cannot actually form an S corporation. You form an LLC, you form a partnership, you form a C corporation, and then you elect to be taxed as an S corporation. The S corporation is a construct of the IRS. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. So I just defined for you what an S corporation is. Now let's talk about partnership, because the whole idea today is to actually understand the transition from partnership to S corporation. What are the fiscal implications that you need to really pay attention to? So let's first talk about partnership. So what is a partnership? A partnership is a business with two or more owners who each contribute money, property, labor, or skills to the operation. Pretty straightforward, right? Now the IRS considers a partnership a pass-through business, meaning all partners share the profits and losses of the business and add their portion to their personal income. And so partners must pay personal income taxes on their share of the business, and partners may also be responsible for self-employment taxes and estimated taxes, while the business itself may owe employment taxes and industry-specific excise taxes. So basically, partnership do not pay taxes at the company level. Okay, they actually file Form 1065, and then they also file something called Schedule K1, and Schedule K1 actually is passed on to all the individual partners, who then must be paying taxes on their at the personal level. So when we talk about partnership, we have three types of partnership. We have a GP, general partnership. We have LP, limited partnership, and we have LLP, limited liability partnership. Let's just define those pretty quickly. So basically, a general partnership, it's kind of similar to a limited partnership with a big difference. When you establish a partnership, you're likely forming a general partnership, which occurs when two people work together to earn a profit. You may not have to officially file with a government agency when you form a general partnership, depending on the state in which you live. And a general partnership does not provide any personal liability protection. You and your partner will bear the responsibility for the business's debts, and your personal assets will be at risk if the business were sued. Although a general partnership doesn't offer legal protection, it requires less paperwork and simpler tax filing than other entities. It may be a good structure for small businesses just starting out. And then you have limited partnership. So limited partnership offers some protections for partners. While one general partner must assume personal liability, the other partners, called limited partners, will be protected from personal liability. and limited partnerships must be formed through a state government agency. This structure will be best for a business with one partner who is active in daily operations and could take on liability, as well as one or more less active partners who contribute to the business but would not want to be fully liable. So limited partners cannot be involved in day-to-day business functions. And then you have limited liability partnerships. So an LLP provides liability protection for all partners, although regulation of limited liability partnerships varies at the state level. The structure allows all partners to shield their personal assets, and partners also will not be responsible for the actions of other partners within the business. So I just wanted to clarify for you what partnership means and what S corporation means. Boss, I want to quickly remind you of today's topic. We are having a conversation about transitioning from partnership to S corporation. What are the fiscal implications? Now, let me talk to you about the conversion tax impact, okay? So what are the tax implications of partnerships to S corporation conversions? This is kind of important. First of all, you have to understand that basically when you actually, you have a tax-free conversion or you have a tax-laden conversion. And the whole thing is that it's all about how you actually approach the thing. It's all about your assets before the conversion, your asset before, your liabilities before, and your assets after, and your liabilities after. So the IRS will have to see whether or not the conversion was actually triggered a tax effect or not. But the thing is that depending upon the situation that you currently have, you might have triggered the conversion might have triggered a large impact or no impact at all. Now the situation is that when we talk about partnership really falls under the state law. See, an S corporation is a federal construct, so it's pretty similar across the board, across all 50 states. But when we talk about partnership, as I just explained to you, this has to actually fall under state law. So I can't really give you a generic sort of answer here. But if you have any specific question about your specific states, let us know, and one of our team members will get back to you. One thing I need to say here is that suffices to say that when we talk about partnership to S corporation, the tax effect really will revolve around 3 or 4 accounts in your financial statements. So the financial statements of the partnership that you have. It also depends upon the general classification that the partnership has before transitioning to S corporation. For example, if you're a general partnership and you want to transition to S corporation, we would have a different tax situation than if you were a limited partnership and you were transitioning to an S corporation. The scenario will be totally different if you have an LLP and you're transitioning to an S corporation. Now, the thing is that there are 3 or 4 accounts that really get affected. So you have assets, liabilities, gains, and losses. So assets, liabilities, we're talking about the balance sheet here, and income and gains and losses. We're speaking here about the income statement. So those are the two account categories, if you will, or 2 categories of accounts that get affected. And the bottom line here is that the impact you'll be feeling the impact not only in your personal tax returns, but also at the business level. Now, I want to talk about a specific cases here when we talk about a transfer from partnership to S corporation. There are two elements that I wanted to really focus on. When boot, including relief from liabilities, is received, then things are a little different. So when the partnership itself or its partners receive boot from the corporation in a Section 351 transaction. Now, Section 351 is a little different here, and so I'll come back to Section 351 later on. But what I want to say is that when the partnership itself or its partners receive boot from the corporation in a Section 351 transaction, taxable gain can result. The taxable gain equals the lesser of the gain realized on the transfer due to the existence of transferred property with fair market value in excess of tax basis, or the amount of boot received, cash plus the fair market value of any other property. But a tax loss cannot be recognized in a Section 351 transaction even when boot is received. If the new corporation assumes liabilities, any excess of assumed liability over the tax basis of transferred property counts as boot, but ignore the transfer of the cash basis accounts payable in this determination. So if you and the other partners are the ones transferring property to the new corporation, each partner is considered separately in determining whether there has been a transfer of liabilities in excess of basis. Now, let me quickly define what we talk about a Section 351 incorporation. The thing is, you can transfer the business assets, liabilities, and operations of your partnership into a C corporation or an S corporation by incorporating the partnership. This can potentially be a totally federal income tax-free transaction under Section 351 of our beloved RIC, Internal Revenue Code, or it can be mostly tax-free. Then you can turn the C corporation into an S corporation. So you first do a C corporation and then an S corporation. And so let's first talk about how Section 351 incorporations work. So Section 351 treatment for the incorporation of a partnership is allowed when all of the following elements are actually met. We're going to put this on the screen. So there are 4. One or more persons, which can include the partnership itself or its partners, transfer property, assets, which can include a cash to the corporation. That's number 1. Number 2, the transfer is solely in exchange for stock of the corporation. Number 2. Number 3, the person or persons, the partnership itself or its partners are in control of the corporation immediately following the transfer. Control means owning at least 80% of the stock. Number 3. Number 4, the transaction has a business purpose. And the IRS created this additional requirements, but meeting it should not be a problem. For instance, incorporating to take advantage of the liability protection offered by the corporate form of doing business will be an acceptable purpose. So would providing for the orderly transfer of ownership of a business from one generation to the next. And I also want to talk about basis of stock received. So when the incorporation is a totally tax-free Section 351 deal because no boot is received, the tax basis of the stock received equals the basis of the property transferred to the corporation, so-called substituted basis. And when boot is received, the basis of the stock equals the basis of the property transferred plus any taxable gain recognized in the deal, minus the amount of any boot received in the deal, relief from liabilities, plus any cash, plus the fair market value of any property. Boss, I want to quickly remind you of today's topic. We are having a conversation about transitioning from partnership to S corporation. What are the tax implications? Now let's talk about the corporation's tax basis and transferred property. So the general rule is that the tax basis of property received by the new corporation in a Section 351 transaction is so-called carryover basis, and carryover basis is really important for future tax preparation. So that means what? That means the basis of the property in the hands of the partnership or partners that transfer the property. So by the corporation's basis is generally increased by the amount of any taxable gain that's recognized by the partnership or partners in the incorporation deal. And let's talk about the corporation's initial tax year. And that's what very important. We're still talking about the Section 351. So in a Section 351 transaction, what happens here is that the new corporation's initial federal income tax year begins on the day after the partnership is effectively converted into a corporation. That is when the Section 351 requirements of 80% of control is met. Remember, we talk about significant control, total control, that's 80% at least. What happens here is that if the new corporation will use a calendar year for federal income tax purposes, the initial tax year will be a short year that ends on the following December 31st. So, but what our team actually recommends to all our clients is that you want to set the conversion dates as December 31st. So the new corporation's initial year is the calendar year that begins the next day on January 1st. It's a lot easier that way. Okay. Now, the thing I want to say here is that you want to make the S election and get the timing right. So your new corporation can elect S corporation status by filing IRS Form 2553, election by a small business corporation. Remember, well, you went from partnership to C corporation and then from C corporation to S corporation. And you want the S election to be effective for the corporation's initial tax year. And to get that result, you want to file Form 2553 by no later than 2 months and 15 days after the beginning of that initial tax year. This is really important. So, it's one of those things where you want to arrange for the initial tax year to be the calendar year that begins on January 1st. So please file Form 2553 no later than March 15th. That way, the S election will be effective starting with the new corporation's initial calendar tax year. And that's what you want anyway. Now, if you somehow miss the deadline to leave let's say to have the S election take effect for the new corporation's initial tax year, you can file Form 2553 at any time during that initial tax year. Then the S election will take effect on the first day of the following tax year. So you always have flexibility here. This is what we call fiscal flexibility, so to speak. But one thing I want to say is that if you want the election to take effect in the S corporation's initial tax year, you want to look for relief. So let's talk about relief for missed S election deadlines, because there is such a thing called a relief. So if you fail to file Form 2553 by the deadline to have the S election take effect on the intended date, the IRS offers a relief procedure. So you can find a plain English version of this relief procedures in the instructions for Form 2553. And so if you qualify for relief, the S election is allowed to take effect on the date that you originally intended, the first day of the new corporation's initial tax year, if you will. So as described in those instructions, you must show reasonable cause for missing the 2553 filing deadline, which is a pretty easy task. Now let's talk about ways to incorporate a Section 351 to structure a Section 351 incorporation. So you can actually meet the Section 351 requirements in 3 ways, okay? And so the way you choose determines the federal income tax consequences that your S corporation will have to cope with. The first way, the partnership transfers its assets and liabilities to the new corporation in exchange for stock, which is then distributed to the partners to liquidate their partnership interest. So this way is preferable when the aggregate basis of the partnership's assets is higher than the aggregate basis of the partnership interest, because the corporation takes over the partnership's basis in the assets. So that's the first way. Everything I'm saying here, if you really need more granularity, if you really need more guidance, please let us know in the comment section, and we'll certainly get back to you. Not a problem. So this is the first way. The second way is the partnership distributes its assets and liabilities to the partners in liquidation of the partnership. In turn, the former partners transfer the distributed assets and liabilities to the new corporation in exchange for stock. This way may be preferable when the partners' aggregate basis in their partnership interest is higher than the partnership's basis in the assets. In effect, the basis of the assets received in liquidation of the partnership will be stepped up to equal the aggregate basis of the partner's interest in the partnership. So what happens here is that the new corporation will then take over that higher stepped up basis. So this is the second way. The third way is that the partners transfer their partnership interest to the new corporation in exchange for stock in the corporation, and this automatically liquidates the partnership since there are no longer 2 or more partners, and all of the partnership's assets and liabilities become assets and liabilities of a new corporation. And this way may also be preferable when the partners' aggregate basis in their partnership interest is higher than the partnership's basis in the assets. So what happens here is that, when the partnership liquidates, the basis of its assets will be stepped up to equal the aggregate basis of the partner's interest in the partnership. And the new corporation then takes over that higher stepped up basis. So the picture I'm trying to paint here is that with proper timing, your partnership can simply convert into a corporation and simultaneously elect S status. Let me just break it down for you. So an eligible entity such as a multi-member LLC or a partnership or LP that's classified as a partnership for federal tax purposes under the so-called check-the-box regulations can elect to be treated as for tax purposes as an S corporation without going through an actual Section 351 incorporation transaction. So under this option, the partnership is treated as contributing all of its assets and liabilities to the corporation in exchange for stock. And the partnership is then treated as having liquidated by distributing the stock to its partners immediately before the close of the day, before the election to be treated as a corporation becomes effective. So what happens here is that if the election to convert from partnership to corporation status takes effect on the first day of the tax year, the entity will be a partnership until the end of the previous tax year and then become a corporation on the first day of the next tax year. So if the new corporation then makes a timely S corporation electing on IRS Form 2553, basically what happens for its first tax year, the corporation will be an S corporation for the entire tax year. Let me give you an example. So let's say your partnership elects to become a corporation effective January 1st, 2030. So the new corporation can be treated as an S corporation for the tax year beginning on January 1st, 2030 by filing IRS Form 2553 by March 15, 2030 to elect S corporation status for that year. Now, there are some S corporation limitations and tax filing requirements. So only domestic entities are eligible to elect S corporation status. I think I've already spoken about that. So an S corporation cannot have more than 100 shareholders, and all shareholders must be individuals and or eligible trust and estates. So unlike partnerships, S corporations cannot make special allocations of federal income tax items. All tax items must be allocated strictly in proportion to stock ownership percentages. Okay, so for loss deduction purposes, partners receive additional tax bases for their shares of partnership liabilities. In contrast, S corporation shareholders cannot deduct losses in excess of their bases in their shares, plus the amount of any direct loans to the corporation. And so this is what it is. And so S corporations actually file taxes on Form 1065. I mean, not 1065. 1065 is for partnerships, but 1120S, 1120S, and Schedule K1. That's how they file taxes at the S corporation level. Thank you so much for your attention. I really appreciate it. I'll just quickly explain to you how to actually transition from partnership to S corporation. And let me do a quick recap here. So I give you the approach, I give you the process, I'll talk to you about the conversion tax impact, and now I'm doing the recap. Thank you so much. God bless you. I'll see you next time. Until then, remember, stay marvelous.